Welcome back to the Global Council powered by WONE. I am Sabarna, and today we are looking at a subject that often hides in the background but can really make or break a deal: tax due diligence in cross border transactions. With me today is Mr. Francesco Mangiameli, Managing Partner at Tax Lean Associates in Milan, a recognized leader in international taxation and a valued member of WONE Global. Now, it is a pleasure, Mr. Francesco, to have you with us today. Before we dive in, why don't you start by telling us a bit about your firm, your practice, and what excites you most about your work?
Well, thank you. Thank you, Savannah. Our firm is basically a specialized firm in assisting investors from outside Italy. We specialize in tax matters and accounting matters and company formation. Therefore, we believe we can say we are highly specialized in assisting foreign investors, foreign entrepreneurs willing to start making business in Italy.
All right. Thank you. Thank you for that introduction. Now, when most people think of tax due diligence, they see it as a compliance box to tick. But you argue it's more than that, a real value driver in deals. So, can you walk us through what you mean by that?
Well, yes, for sure. Most people tend to view a tax due diligence process or exercise as a defensive exercise. Actually, the basics of a tax due diligence work is to check tax returns, is to look for unpaid liabilities, is to check whether the overall behavior, tax behavior of the company has been proper or otherwise. But this part is essential for sure, but more can be done. In essence, if tax due diligence work is also viewed as a strategic tool for increasing future tax efficiency, well, that would be the best out of a tax due diligence work. So that this work may not be just a compliance safety exercise, but a tool, for example, to shape pricing, even the deal structure itself, or post-deal synergies. These are aspects which can be implemented in a proper way thanks to a proper tax due diligence work, which is a way, as a matter of fact, to indicate the right path for future steps.
All right. So what I understood was that it is a strategic tool that we are looking at, and that tax due diligence isn't just about avoiding mistakes, but it can actually make a deal smarter and more profitable. Am I right at understanding that?
Well, I can give you an example of how a strategic view of tax due diligence work may be important and may add value to the entire deal and future. For example, during on field, during the work, you may detect assets which value is not properly reflected in the books. Because, for example, certain IP rights could have a higher value, or other assets could be stepped up for tax purposes. In this regard, obviously, an asset deal versus a share deal would probably be more convenient on the buy side in order to an asset deal would allow the buyer to step up the tax basis under certain conditions, of course, but the underlying requirement would be to have an asset deal in place. Otherwise, a share deal would not put the buyer in the position to reevaluate assets. This is just an example. Another example, on the other hand, if the purpose would be to minimize the tax cost of an acquisition, Maybe an asset deal, a share deal would instead be preferable under other circumstances. For example, when liabilities are not that high. Uh, so there is a combination of factors which can be detected during the work and which are capable to make you decide which kind of structure would better fit the buyer or the seller, depending on who you are assisting.
Okay, thank you. Thank you for explaining it even further. And now let's dig deeper into the hidden layer. So, what kind of issues tend to be uncovered in cross border tax due diligence that could surprise deal makers?
Well, one typical example that there are many. One typical example, however, and at least in Italy, is a really a common issue which has been debated a lot on field is the issue of the qualification, the possible qualification of an existing permanent establishment, or better, hidden permanent establishment. It may happen that during the work, certain clues of existence of hidden of a presence of a PE, so-called PE of a foreign entity may be detected. For example, interviewing people, domestic people, you may discover during the work that there is people working in the interest of a foreign entity. This could be a clue of the existence of a presence, of a tax presence called PE or the foreign entity. This is a very, very common example, and this could obviously raise risks. Other typical examples of tax issues which may be detected during the tax due diligence work, cross-border work, is the, the non-proper application, the non-compliance of withholding taxes, especially talking about outbound dividend or interest or royalties payments. Any payments may trigger domestic withholding taxes, which could be maybe reduced or even avoided based on certain requirements. But there could be cases whereby withholding taxes should have been applied, but they didn't, and therefore this may be detected as a typical cross-border tax issue. Another example could be obviously anything related to transfer pricing policy. If the target belongs to a multinational group, it is quite likely that transfer pricing issues and concerns may arise out of transfer pricing policies in place, or compliance to local transfer pricing requirements, whether or not, for example, local file and master files are up to date, or whether or not they are fully in compliance with Italian requirements, and so on. But not only, also certain issues should be viewed in the light of the possible acquisition, because after the acquisition, scenarios may change, may vary, change of control, maybe discontinuing businesses. These plans, if any, may jeopardize the tax attributes in existence. For example, in case of tax credits or tax losses, tax losses, for example, can be carried forward provided that certain conditions are still in existence, for example, in case the business model is not changing or together with the controller. So there could be cases to be checked in the light of the future plans, post-acquisition plans. Other typical cases could be related to VAT, so international VAT would be a trap to some extent, or also other aspects, for example, existing pending tax litigations or anti-avoidance rules maybe not properly tackled. For example, I'm thinking of hybrid mismatches or disallowed deductions or other aspects related to tax residence ambiguities, which can create double taxation or at least administrative confusion. There are many. Actually, there are many. Many are the issues which can be discovered during tax due diligence work.
Right. Thank you so much for those insightful examples, which gives us a better idea into the subject matter. And these aren't just small footnotes, they can reshape the entire deal structure if, not paid attention to or caught early. Those small details, thank you for those. Now, if you had to briefly, tell us that once the risks are identified, how can smart structuring, like things like earn-outs or integration planning or transfer pricing adjustments, actually turn those findings into value?
Well, earlier I touched one good example that is how to structure the deal. For example, during the deal, after the tax work, contingent tax liabilities could arise. And obviously, this could become a blocker, or at least this could become an issue which may affect dramatically at least the timing of a negotiation and relative conclusion of the deal. Obviously, the buyer would tend to avoid any risks that in the future that contingent liability may become an actual liability. On the other hand, the seller will tend to close the deal in some way. Well, in the presence of contingent liabilities, then the effect on the deal structure would have to be tackled. For example, one way to fix the issue, the negotiation issue, would be to include an earn-out clauses on the basis of which the price amount would be subject to the condition that in the future no actual liabilities would indeed arise, for example, or other clauses capable to protect the buyer from future negative outcome out of the uncertainty. Again, the tax due diligence work is capable to indicate the proper way of how to structure the deal. Or another example of added value could be based on the tax due diligence work, could, for example, be after acquisition the opportunity to restructuring the group of companies maybe which were part of the target in order maybe to simplify chain controls and therefore to create opportunities of synergies of simplification of the group, also in the light of future integration with the buyer. So these are all examples of added value which could arise out of a due diligence work. And last but not least, also during another good example would be to when potential opportunities of stepping up assets, as I said earlier, these potentialities would tend to give the buyer the opportunity to choose the better way to proceed along the lines of the acquisition. For example, in order to step up assets, a convenient and usual way is to merge the company, the target, to vertically merge the company in order to get the possibility of stepping up the assets of the target. And obviously, all these future possibilities rely on the same beginning tax diligence work, because during that work you could identify these type of opportunities.
Right. So the right approach then transforms due to diligence from a defensive step into a strategic advantage. Now,
Yes.
you are based in Italy, but you work across borders. So, how do international framework like OECD guidelines, EU directives, or even recent reforms like Pillar 2 shape the way tax due diligence is done today?
Well, definitely there are a lot of impacts from various sources impacting a tax due diligence work, a cross-border tax due diligence work. Not only cross-border, but in general, anytime a target is involved in a multinational environment, in a multi-jurisdiction environment, many aspects have to be properly taken into account during tax due diligence work. For example, a typical area of investigation is besides the TP regarding goods, also the area of intercompany charges is a delicate area which is definitely worth being reviewed. Also because Italian tax authorities tend to check this area anytime a tax audit is started. So it is highly probable that the potential issues, if any, existing in this area may come out at a later stage, that is after acquisition. Or another aspect for sure to be taken into account is the presence of certain regulations, such as you mentioned, Pillar 2. Actually, Pillar 2 is something which is these are new regulations, but already in place. So, since the underlying rationale is to ensure that at least a minimum tax is paid in each jurisdiction where a multinational group operates, minimum being 15%. These regulations are shaped in a way that in case in any jurisdictions the group subsidiary may fall below the minimum threshold of 15%. Well, in such a case, the so-called top-up tax has to be paid. Therefore, the impact on due diligence work may be important in case of non-compliance with this type of regulations. So nowadays, tax due diligence work has to cannot avoid taking into account the impacts from international regulations such as Pillar 2 or other compliance or compliance to other international requirements. Thinking, for example, certain reportings which have to be made by multinational groups. Non-compliance to this reporting, which is called country-by-country reporting, may trigger penalties or even worse consequences. So these are all aspects which have to be checked anytime a target is a company involved in a multinational and international environment.
Right, exactly. Like how the landscape is shifting so fast, so even due diligence has to keep pace with it. Now, for our audience of business leaders, lawyers, auditors, and advisors, what's the one piece of advice you would give about making tax due diligence part of deal strategy, not just compliance? Yes, indeed. The a very basic message is could be the following. Never look at tax due diligence work as just a compliance exercise, but just look at it as a forward-looking value driver. And it can become a value driver if it is associated basically with the advisory part of tax profiles. In conclusion, really in conclusion, all the time my recommendation is to buyers essentially is please have tax experts attending not just risk tables but also strategic tables because the added value which the tax side may create could be really important. Right. So foresight in tax isn't just technical then. It's a commercial leadership. Am I right to understand that? Yes, of course. All right. It's a strategic opportunity. Mhm. Thank you. Thank you, Mr. Francesco. That has been a very sharp conversation. You've shown us how tax due diligence, often overlooked, can actually drive deal values and reshape the outcomes. We are very proud to have you as a WONE Global partner and look forward to meeting you in Barcelona. Now, this. Thank you very much indeed. Thank you very much indeed. Yes, I will